Well, Loeys is Global Head of Market Strategy at JPMorgan Chase, and he joins us now from New York. Welcome. As ever, we get a lot of emphasis put on Alcoa, and although commodities should have helped it, oil is going to be a big concern for a lot of companies reporting this quarter, isn't it?
Well, oil, I think, is more an issue for coming quarters for economic activity. I mean, the past quarter, the main issues is overall economic growth is probably only about 2%, so that's going to be affecting top line a bit. The consumer was on the weaker side too. Those are your negatives. On the more positive side, I'd say, analysts have already put it into their forecast. So bottom-up consensus is actually for lower earnings than we had in the fourth quarter. And the dollar, you mentioned as a negative, I would see it on the positive side. It gives you positive currency translation effects. Don't think that's fully in analyst forecasts. So I'd say the odds are still that earnings by themselves are going to be surprising on the upside.
Right. And what sectors do you think particularly are likely to do well? I'd
say from an earnings point of view, the upside is more on the financials. And, I think the first quarter, from the way we're looking at things, financials will have probably an ability to release some of their loan loss reserves. They've still been riding the curves. The SSA own are probably up on the month. I'd say financials is where I would see from earnings the best upside.
And those companies who've got exposure to emerging markets, are they ones that you would expect to do well in the current climate?
Well, clearly emerging market growth is outperforming the developed world by a massive margin. I think 4 to 5 percentage points at this point. Now, currencies in emerging markets are also way up, I'd say, versus the dollar 5-6 percentage points about. So you have two factors that should make U.S. companies reporting that have big exposure to emerging markets. They should be showing some upside here.
No, there is a lot of budget wrangling in the U.S. It's going to be continuing. Does that bode ill for U.S. treasuries right now?
It is a negative. The question is how big a negative is it's really. The discussions last week were a bit of a dry run for the issue on the raising of the debt ceiling for the United States. We know sometime in May. The U.S. says it is going to be to some degree running out of money unless you take some extraordinary measures. With extraordinary measures, they'll have until about July. So we don't know exactly when Congress will come to the point of raising the debt ceiling, but it's going to be up to the last minute. So that wrangling around creates some risk, small as it is, and probably rising, of some form of a technical default. That pushes bond yields up. How much? We don't think we're going to be crossing 4% over here. At that point, the curve would be so steep, it'd be so attractive for international investors to get back in. So I'd say give it 10, 20 basis points upside in coming months.
Okay. Now, as we look ahead beyond the first quarter, do you see the issues that are currently affecting the currency, the equity markets, like the events in the Middle East and Japan, as continuing? And what about other downside risks like the sovereign debt crisis in Europe? Is that playing into your thoughts right now?
Well, if you look at all the things that you mentioned, what is going to be a negative for the US dollar, the exchange rate versus Europe and versus emerging markets, is the Federal Reserve continuing to emphasize it has no inclination to tighten this year, probably not next year either. The wrangling around fiscal policy creates worries about credit quality of U.S. government debt, both public and local. Those are all negatives for the dollar versus the rest of the world, which is why you want to be underweighting the U.S. dollar over here. The sovereign debt crisis in Europe, I think now is a more minor issue. It's not a big question for markets anymore. It's affecting the smaller countries in Europe. More important is going to be oil prices. That's the one factor that is standing out there that is inducing investors to lower growth forecasts and is inducing investors at the moment to lower their equity weights. Our best guess is still we're moving in Brent terms now in the mid-120s. closer to 110, if not a bit lower than that. But if near term, the next 1 or 2 weeks, risk is on the upside on that.
Jan Loeys, thank you very much indeed for joining us from New York.
Pleasure.